From the City of London for our audience worldwide, Bloomberg Real Yield starts right now. We begin with the big issue, markets grappling with near-term risk and long-term hopes.
Investors have yet to decide which narrative they are going to go with.
The setup for 2021 is quite positive.
But I think there's a lot to get through first.
Over the very near term is a lot of choppiness.
Honestly, the virus is really raging out of control.
There's a lot of uncertainty around the profit outlook for markets.
The resurgence of the virus.
People are going to be talking about nothing but the misery that COVID is inflicting upon us.
Volatility will still stay high for the weeks to come.
When you look toward next year,
we could see the economy doing much better by the end of 2021.
2021, we will see an acceleration in growth.
We will go into 2021 with more optimism.
We had a big kind of euphoric rally.
We saw credit spreads really come in a lot.
Even then, we were taking some chips off the table.
Basically, this tug of war.
Do you look at the near-term challenges or do you look at 2021?
I've been looking to this conversation, looking forward to it over the last couple of days, and I'm pleased to say that Gershon Distenfeld, with his mask on from AllianceBernstein's, good practice for social distancing. Not in this environment, though, Gershon. You can take it off for the interview. He joins us right now. Gershon, it's great to catch up, sir. The short-term risk versus the long-term risk. That's part of the big conversation at the moment. And one thing you've said, Gershon, that I think is really important is that you can't draw a hard distinction between the short-term and the long term, that the short term can actually shape the long term. Can you walk me through your thinking at the moment?
Absolutely, John. But I just want to tell you, the mask it's not what you think. It's not that I lost a bet. It's a plea for you to come home, John. You don't belong in the UK.
I'll come home soon.
Just because we don't know how to run elections here doesn't mean you can't come home. I mean, you guys might have voted for Brexit over there, but you not exactly know what you're doing over there. So please, John,
I don't think you want me to weigh in on the election right now. I don't think you need the view from London, Gershon. I'll come home soon. Don't worry about that. Can we get to business and start with the question?
Absolutely, John. Yeah, so look, I think it's very important to really separate out the long term from the short term. The short term, we got great news this week on the virus. That's obviously great news. It remains to be seen some of the details. But remember, the vaccine. I think I said the virus. The vaccine itself, though, doesn't put anyone back to work today. We're still going to need fiscal support here. The monetary authorities the Fed's done everything they're supposed to do and then some. We're going to need more fiscal support in the short term. But even if we get the vaccine and everything is rosy, we have to remember there's a longer term picture here. We've been in this kind of rut for a decade plus now of low growth, low inflation. And we're going to, in order to get out of that rut, we're going to need the fiscal authorities, fiscal stimulus to play a big role in that over the next few years. And divided government is unlikely going to provide that. I know that the conventional wisdom is that divided government is good, but when you need government to actually help you get the economy back on track, it's not necessarily so good.
So, Gershon, this is really important because we came into this crisis, this pandemic, with quite low trend growth. There was a hope that the Trump administration could get us out of that. Are you essentially saying that even if we do have a vaccine in the long term, the decisions made now and the decisions that we stick to through the medium term into next year could basically end up where we were last time, which is low trend growth, low inflation, a huge monetary policy regime, but same as before?
I think that's very possible. Look, one of the things, whether you like or dislike what the Trump administration did, he did a lot of the things he said he was going to do. The one thing he didn't do was spend a lot on infrastructure. And I think that's going to be key going forward. Certainly, I think the Biden administration is going to be willing to do that. The question is the Republican Senate, assuming that they do hold at least one of the two seats in Georgia, and a Congress that is certainly, while still be controlled by the Democrats, is going to be much weakened. Are they going to go along with it? Are the Republicans going to find kind of newfound religion, quote unquote, in terms of spending and deficits? I think the bet you would make is they will. And, are they going to have the ability to do what they need to do to help the economy going? And I think you have to bet against that at this point.
Well, Gershon, let's talk about markets then. This is the framework for thinking about the world right now, your framework at least. Let's talk about high yield, an area of fixed income that typically you're quite constructive on. I want to start with price. You can look at absolute yield near the lows we haven't seen for a long time, if ever, or you can look at the spread and you could say we've got 100 basis points still to go before we get to the tights of the year. What's the best way of approaching that right now as an investor, Gershon?
Well, I think the positive way of looking at it is you can compare it to what happened when Europe got to these kind of yield levels. And there, you still had a long way to go in terms of price appreciation because spreads went a lot tighter and the underlying yields kept on going lower. That's unlikely to happen in the United States, right? The Fed has been pretty clear that they're not going to go negative interest rates. You have a huge, money market here, so to speak. The Fed has been very clear they're going to keep on doing more QE, yield curve control, more forward guidance before they go negative rates. So it's unlikely you're going to get the same kind of outcome you had in Europe over here. So I think yield does become much more important here in the United States. And you look at that kind of closing in on a 4.5% yield. Remember, in order to get what I would call a clean portfolio, where you don't buy the kinds of things that are trading at levels, they might have a 15% yield on it, but you don't really believe it because they're probably going to have to restructure. You're looking at a yield of closer to 4%. So it's priced kind of for perfection. And we believe that for investors that need yield, they need income, there are better alternatives today to U.S. high yield.
So I know one of those alternatives is EM. I just want to sit on high yield just for a further question if I can. Gershon, many people believe that this credit market is really insulated in the United States because of the role of the Federal Reserve. Do you just not like the yield for the risk you'd have to assume in the United States? Or are you worried about spreads gapping wider, even with the Fed having a presence in the credit market in the United States?
Well, I think it's always hard to, I'm always reluctant to answer getting paid for the risk because that means different things to different people. I mean, in fixed income, it isn't like other markets. If you are a long-term holder, let's say you had this magic, yields are 4.5% today. Really, they should be at 6%. As long as you don't have massive defaults, it just means you're going to earn less than you would have otherwise. It doesn't mean you're going to lose your shirt. That being said, I do think that you are, as I said, priced for perfection today. You're not priced for a lot of bad things to happen. On the other hand, though, it is important to note that unlike the equity markets where, multiples would suggest that you need to have a decent amount of growth in order to justify the valuations of today, the credit markets are somewhat bifurcated. You do have your companies that, quite frankly, it was the E&P space, the retail space, they were going to be in trouble and probably have to restructure, even if we never had COVID happen. And on the other side, most companies have had years of ample liquidity, access to low rates, have been able to term out their maturities, so they're going to be okay. So I don't think there's a disaster coming down the road. I don't think we're going to have massive defaults above what we already on hand. We all affection. There isn't a lot of upside here either.
Gershon, just a final question for me then on diversifying. You've made the push to say diversify by going abroad and don't be afraid by emerging markets. Walk me through the thinking around EM right now. It's something that comes up a lot in conversations I have, that people want to diversify by going abroad. And it's something different, that they're worried about the risks in the United States and more interested, more compelled by the opportunity in emerging markets.
Yeah, John, I think that there's some things that are misunderstood about emerging markets. People are citing the high defaults this year in emerging markets. You look at Argentina, Lebanon, and Ecuador. It's important to remember those were all headed for a restructuring sometime in 2021. It just got moved up from the COVID crisis. You don't have a lot of problem areas elsewhere, so we're not expecting a lot of defaults there. You think about lockdowns have been much less severe in most emerging economies. A vaccine actually should be more positive for most emerging economies that are reliant much more on tourism. So a lot of good things, to the extent we do get growth, a rising tide lifts all boats, a lot of good things going on in emerging markets, and there's a lot more yield there. So one has to be very, very careful. I wouldn't just say, just go buy blindly every emerging market economy. There's certainly corporates that are interesting in some areas of the world, but in general, we are finding more value in emerging markets than we are in kind of domestic corporate high yield.
Gershon, great to catch up. We'll have to continue the conversation, particularly on the currency exposure as well. Stay safe, wear a mask. I know you will. Great to see you, sir. Thank you. Time now for the final spread. The week ahead coming up. Another 5 days jam-packed with Fed speak. Vice Chairman Richard Clarida kicking things off on Monday, followed by Presidents Bosticks, Daly, Rosengren, Kaplan, Williams, Bullard and George, all speaking throughout the week. Plus the data point of the week, retail sales coming on Tuesday. And finally, another round of jobless claims on Thursday. That does it for us. We'll see you next Friday at 1 p.m. New York time. That's 6 p.m. in London. For all of you at home, our audience worldwide, you stay safe too. This was Bloomberg Real Yield. This is Bloomberg TV.